Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
There are countervailing data points, right, which don't describe like a consistently overheating economy or a consistently underperforming economy, and hence why people are talking about this sort of K-shaped economy, right? As I think about some of the major points that you're making, overall, I agree with you, starting with the inflation point, and we can bring up that slide. I, for some years now, believe that we're in a structurally higher inflation environment. And this is even before considering energy, which is, the very good points you were making around not just data centers, but energy for the consumer. I think because of the shift in geopolitics, because of what we're seeing around wage growth, because of AI, so including data centers and even just the energy complex around critical minerals, that we are in a structurally higher inflation environment. So your 3% we agree with, and I don't think we're headed far lower than that anytime soon, especially when you consider the fact that we're at these high levels of inflation and rates are this high. Right. And we're going to continue cutting rates. So rates are helping to constrain inflation, but they're headed lower. So that downward pressure is going to be removed. So I agree with you that inflation trends higher. On the energy costs, it's interesting. I agree with you that we should brace ourselves for higher costs because, in the US over the past 10, 20 years, energy price growth or energy consumption has been flat. And going forward, just because of data centers, we expect that to grow on a CAGR basis, right, to 2-3%. So that's massive, especially when you think on an individual basis how much energy data centers consume. That plays into the consumer, but as you know, from a Fed perspective, the Fed is thinking X energy, X gas. So that's not necessarily part of the Fed's thinking. That said, our goal, our forecast is that the Fed cuts one more time this year and then cuts 3 times next year. What's interesting about that is the dispersion around those views is at its widest levels right now, right? Because back to the same point you're making, I'm making, there's some people who say the economy is great and other people say the economy is extraordinarily weak, right? And there is truth to both points of view. I would argue that the GDP numbers are clearly surprising to the upside, but embedded within the GDP numbers are really amazing investments in AI, right? And when you strip out, if you're, it's a complicated process, but if you could strip out AI investment, growth is not as strong, right? And you're talking about a weaker labor market, housing has been weak, and there are businesses whose balance sheets or business models are not withstanding these higher interest rates. So it's sort of a both and. But I find that interesting. So that's the Fed. Maybe a couple of more points I'd make. I think your AI point is an interesting one. Clearly, there's a lot of concentration risk in the S&P, and so you're seeing tech stocks drag global markets down when as investors are concerned about AI and sort of Peter paying Paul and what pot is driving the AI boom. I'd say fundamentally for companies and for the economy, we need AI to support productivity, and that is what is going to drive growth. We no longer can rely on population growth or working age population growth to fuel the economy. So it's all about productivity. And how are we going to get that productivity? It's through AI, right? And so it is true that not all of this investment is going to be productive, in my view. There will be winners and losers. And so you have to be careful about how you're invested. For ourselves, we think about investing in the compute infrastructure. So yes, the data centers, but the data centers that have, real demand drivers behind them. But then the power networks, to your point, are going to be needed regardless. But I would say there probably are bubbles within AI, but AI in of itself is going to be critical for future growth.